According to Bank of America, the Fed will double its balance sheet by the end of 2020 based on the current trajectory. This would be highly inflationary, and that's quite the point. What have we learned from history about previous bear markets and the eventual bull market that follows? This can give us insight as to what's going on and what may happen. You came here for the truth, so let me unveil that for you. Today we are going to look at some very good detail about what has happened in the markets, about what the Federal Reserve has done, and I'm going to show you everything you need to know right now. Let's begin. On the left-hand side, you are looking at the chart from Bank of America that shows you the Federal Reserve's balance sheet as well as the anticipated or projected result of their QE4 and 5 programs. This is a shocking spike upward, but of course, as you have seen with all of their announcements, with everything they've been doing, with every letter of the alphabet they're adding in all these new programs, this shouldn't really surprise us. It's just incredible to see. They project that this will be $9 trillion by the end of 2020. So it's basically a doubling from the end of 2019 into the end of 2020. The way that they're going, this is absolutely possible, but they might start to taper this program off and reduce that. At least that's what they want to do. I'm not sure if that can actually happen. If the markets do come up, if things do get resolved, it is possible. But just like we saw back in 2018, they cannot do that for long. Right-hand side, Fed's balance sheet as a percentage of the US GDP, it is looking shocking as well. So not in dollar terms necessarily, but seeing it in the percentage of the US GDP. And that, of course, assumes that things stay the same with the GDP. Who knows what will happen? We could see a shocking spike downward in the GDP and then things really get thrown off here. But this is just a forecast and you know what it's all about. Left-hand side, central bank balance sheet is as a percentage of the GDP, and this just shows you a little bit outdated data, but just to give you a comparison of the Bank of England, ECB, BOJ, and the Fed, all of them are massive, but when you compare this to the GDP, the Bank of Japan is the winner. I don't know how you want to look at that. I guess the loser in this case. On the right-hand side, Fed balance sheet as a percentage of the marketable US Treasury debt outstanding. It looks a lot like what's happening with the balance sheet as a whole. They are going to buy anything and everything. They have already made that known. It is very clear to me, at least. I know it is to you as well. They will monetize the debt even when there's no more available. They will issue more debt from the government. Federal Reserve will print the money out of thin air and they will buy every penny. This is the same data, but looking at it in a table format for some people who might see that better. You can see where they're going. It just shows you December 2020 right at the very bottom, the total showing over $9 trillion. This information comes directly from the Federal Reserve's website. I wanted to make this known. I didn't mention it before because it's not so black and white, but regardless, reserve requirements as announced on March 15, 2020, the board reduced reserve requirement ratios to 0%. This action eliminated reserve requirements for all depository institutions. So straight across the board, no more reserve requirements. We have seen all central banks around the world basically reducing these after they say they were tightening. They were actually reducing. They said that the stress tests showed that the banking system was very sound. We know it's not, and we're going to have some real world tests in the next few weeks. But this just shows you how far they're willing to go. Where it gets a little complicated is that they never really needed to have any reserves anyway, as far as I'm concerned, because the Federal Reserve would have always been there to create an infinite amount of reserves, and they have established that. They've made that clear. That's the way I look at it. Of course, there's a lot to this. It's the financial system, so it is convoluted intentionally. But regardless, all you need to know is that easy money has become even easier. This article here out of Bloomberg is basically talking about what has happened with the special purpose vehicle, how the Federal Reserve is now buying corporate bonds, they're buying ETFs, suggesting right at the top here, to put it bluntly, the Fed isn't allowed to do any of this. The central bank is only allowed to purchase or lend against securities that have government guarantee. Talking about treasuries, mortgage-backed securities, and so on. Here they talk about the special purpose vehicle, how it works with the treasury. I'm not going to break down everything. You can read it here for yourself. But there's one very very important thing that I wanted to note in here because I saw misinformation spreading around the internet, and I need to make this very clear. The federal government is nationalizing large swaths of the financial markets. The Fed is providing the money to do it. BlackRock will be doing the trades. And I quote, "This essentially merges the Fed and the Treasury into one organization. I must make it very, very clear. This is not true. This is absolutely not true." I know he puts the little caveat here, essentially, but there is no difference in what was going on beforehand up until now. There is no merger. There is no takeover. That is not the way it should be described. The Federal Reserve is not part of the government. In fact, I've done a video about it before, but we had Jerome Powell himself say, "We are not part of the government." I believe the quote was, "The Fed is not part of the government." It wasn't then, it isn't now. Now, do they operate as a quasi-government institution? Absolutely. But what's very important is that even today, the Fed sits on top of the Treasury. They work together. They definitely work together. But as I noted with, I believe it was Neil Kashkari, they talked about the digital printing of dollars. That's the Fed. But the paper printing of dollars, that's the Treasury. Now, when we talk about the special purpose vehicle, the Fed can't do it because they didn't want to go through Congress. It was an emergency measure. So they did it this way. It's very convoluted. There's no doubt about it. But again, that's the way this system works. It's on purpose. But in no way, shape, or form is this some sort of takeover. The government is somehow going to be controlling what the Federal Reserve does. If you believe that, please go back to the person who told you about it, who explained that to you, and ask for a refund. The information they sold you is incorrect. This article was from March 26th. Dow rallies 6.4% after stimulus vote. Wow, fantastic. The blue chip index is now up 20% from its low. You know as well as I do that this has been an extremely volatile market just over the past few weeks. I have a chart to show you. This one first gets into bear markets comparable to 1929 and 1987. That blue line right there, that's the S&P 500 right now. It was more aggressive than those previous instances. Looking a little bit closer here, we see that as of February, things were looking fantastic. The market was moving up despite all the negative news that was appearing. And then finally it woke up. As you can see, there was a dead cat bounce that occurred once before. The market fell even further. And now we have this rise that has some people starting to ask questions. We went from the fastest bear market in history to the fastest bull market in history. The volatility is so extreme, nobody really knows what's going on. There is potential for this to be another dead cat bounce as it goes lower. There are many factors at play here. The stimulus, that $2 trillion stimulus, this is going to need to go up and up and up. We need to see more than 2 trillion. They need to go to 4 trillion. They need to go to 6 trillion. Not because that actually fixes the problem, but the algorithms love it. The Federal Reserve policies of 0% interest rates need to remain at zero or hopefully even a little bit lower because the algorithms, they'll love that too. The quantitative easing measures, their best bet is to not taper that. It would be disastrous for them to do so. Now, they did just a small amount on Friday's trading session, and we saw what happened in Friday's trading session. It wasn't good. Where they correlated, not necessarily, but certainly the market doesn't like it when there's any form of reduction in quantitative easing, even though it has come up so far. Even if that starts to slow down, the pace at which it increases slows down, you got a big problem. These right here are the primary factors for where the market is heading. Keep a close eye on these. Now let's look at history. S&P 500 performance after 20% decline since 1980. It's certainly a mixed bag, as you can see right here, but this just gives you an idea of the previous cycles, how they behaved. I think it's more important to look at what's happening right now, to gather all the data that we are seeing, to look at the response here coming from the government, coming from the central bank, and to necessarily compare this to the historical charts. But if you want the information, here it is. S&P 500 bounced by 9% to 19% 6 times between September and December 2008. Of course, the low point here being March of 2009, where the S&P 500 hit 666. Many people were trying to buy the dip, and it really did not work out in this case here because more bad news piled on. They didn't understand what derivatives were at this time, even though if they would have read Frank Partnoy's book, they would have got it, because I'm pretty sure it came out before the crisis, but regardless, people are always over anxious. Growth versus value, RIP value investors. So there was a few instances in which we would see growth actually lagging behind value, and that tends to happen when people are worried, but not too worried. As you can see here, it's getting worse and worse. You can look at this period where it was rising. That's fourth quarter of 2018. Portfolios were starting to readjust, but just look at the trend line. It is very clear. Growth is where it's at. People want to take that risk. And why? Because we have 0% interest rates. Because we have risk taking being the number one action for investors today. That's the way they're going. The US economy has come to a standstill, satellite imagery shows. You can look at the GDP, you can look at PE ratios. There are all different typical indicators that people will use. If you talk to your financial advisor, if you talk to the average analyst, this is what they're going to say. Look, the GDP increases this much every single year on average. You take the stock market, it increases by 7% on average. The average bull market lasts for 7 years. There's all these numbers that they throw out in front of you. They really don't know too much, but they got their certification and now they could sell you the junk. But when we look at the anecdotal evidence, when we look at what I call second and third tier data, I really think it tells more than what we get from these primary indicators. I do like to use the indicators on occasion, not as a total number, for example, the GDP, but when we look at it as a percentage, or we look at it as a ratio comparing the GDP to something else, then it maintains some value. But regardless, something like this doesn't really lie. If nothing's moving, you see the pollution's falling, you see all these different things that have been adding up as I've been covering it, really it does not look good for not just the US economy, but the global economy. There's some really good images in this article out of CNBC if you want to check them out. Link will be in the description. I was going to go a lot longer on this video, but I think it's best I cover the economic aspects in a separate video. So perhaps I'll do that for tomorrow's video. Check it out. As always, I'm producing so much content these days because it's just flowing in like crazy. So I think I'll leave it there. If you found this video informative, hit that thumbs up button. I'm trying to give you the history. I'm trying to give you all that data. And if you appreciate it, please hit the thumbs up button. If you hit the like button, you're supporting me. Thank you very much. If you want to see content from me all day long, I produce it on Instagram and Twitter very, very regularly. In fact, on Instagram 3 times a day, Twitter with all of the data that goes there, it's even more. All very useful, all very relevant at The Money GPS. Right now, working online has become a trend. Well, if people would have understood this beforehand, that something like this could happen at any moment, any part of the day, perhaps more people would have been ready for such a disruption. I created a free e-course to teach you how to sell products online. There is no catch here. Check it out at the AmazonGPS.com. If you want to know the financial system, everything from top to bottom, A to Z, but you want it to be simple, these 2 books have everything you need. Check them out at the link in the description. If you want the audiobook, themoneygps.com. Gold is an asset that does particularly well during inflationary periods. This video here talks about gold, where I stand on gold, everything you need to know. Click on it. I'll see you there.